There is a number that should make every American's blood run cold, and it is this: if you earn less than $25,000 per year and claim the Earned Income Tax Credit, a benefit specifically designed to help working families escape poverty, you are more likely to be audited by the Internal Revenue Service than someone who earns $500,000 per year. This is not a mistake, not an accident, not a temporary anomaly that will be corrected once someone points it out. This is the deliberate result of decades of budget cuts, political pressure, and a fundamental reorientation of enforcement priorities that has transformed the IRS from an agency that was supposed to ensure everyone pays their fair share into a machine that squeezes the poorest Americans while allowing billionaires to hide wealth in ways that would take teams of specialized agents years to uncover, agents that no longer exist because Congress systematically defunded the very department that was designed to catch sophisticated tax evasion. And what makes this truly perverse is that the people being audited, the working poor who claim the EITC because they have children and work full-time but still cannot afford rent and food, these people often owe nothing or are owed refunds. But the audit process itself is so intimidating and time-consuming that many simply give up forfeiting money they desperately need because they cannot afford to hire accountants or miss work to gather documentation that proves their children actually live with them and that they actually qualify for benefits that Congress created specifically to help them. But it was not always like this. And to understand how we arrived at a place where the tax system punishes poverty while rewarding wealth, you have to go back to the 1990s when the IRS was one of the most powerful and feared agencies in government, capable of auditing anyone regardless of wealth or political connections, and equipped with thousands of revenue agents trained to untangle complex offshore structures and partnerships and trusts that wealthy people use to hide income. The IRS in that era collected more than 93% of taxes owed, an extraordinary rate that reflected both the agency's capabilities and the public's belief that cheating was likely to be caught and punished. And this high compliance rate meant that honest taxpayers were not subsidizing cheaters, that the system was reasonably fair, even if nobody enjoyed paying taxes. But then came a series of congressional hearings in 1997 where senators paraded taxpayers before cameras and told horror stories of IRS abuse, of agents who were too aggressive, too intrusive, too willing to seize assets and ruin lives over disputed tax bills. And while some of these stories were legitimate, many were exaggerated or involved cases where the taxpayer actually owed the money and simply did not want to pay. The overall effect was to create a political environment where being tough on the IRS was good politics and defending the agency was political suicide. Congress responded by passing the IRS Restructuring and Reform Act of 19, which imposed new restrictions on collection activities and created a burden of proof requirement that made it harder for the agency to win disputes. And more importantly, Congress began cutting the IRS budget year after year, reducing enforcement staff from over 100,000 in the late 1990s to barely 70,000 by 2020. A 30% reduction. Even as the economy grew, the tax code became more complex, and the number of returns filed increased by tens of millions. These cuts were not distributed evenly. They fell disproportionately on the divisions that audited high-income individuals and corporations because those audits required specialized expertise, took years to complete, and often resulted in legal battles with armies of lawyers and accountants defending every dollar. While audits of low-income EITC recipients could be done by lower-level staff using automated systems that flagged returns for simple inconsistencies that could be resolved with a letter. From a pure resource allocation standpoint, if you are an IRS manager with a shrinking budget and political pressure to maintain audit numbers, you audit the poor because it is easier and faster and generates statistics that make it look like you are doing something, even though the revenue collected is minimal and the social cost is enormous. And here is where the numbers become truly damning. According to data obtained through Freedom of Information Act requests and analyzed by organizations like the Taxpayer Advocate Service and the audit rate for taxpayers earning under $25,000 who claim the EITC is approximately 13 per thousand, while the audit rate for those earning between $200,000 and $500,000 is only 7 per thousand. And for those earning between $1 million and $5 million, it is only 8 per thousand. The only income group audited at higher rates than the poorest Americans are those earning over $10 million per year. And even then, the rate is only 16 per thousand, barely higher than those living in poverty. But the real scandal is not just the rates, but what happens during these audits. Because when the IRS audits a low income taxpayer claiming the EITC, they typically send a letter demanding documentation that the children claimed on the return actually live with the taxpayer, which sounds reasonable until you realize that many poor families have informal living arrangements, that children might stay with grandparents or other relatives part of the year, that kind of documentation the IRS wants. School records and medical records and signed statements is difficult for people who move frequently or work multiple jobs together, and that many of these taxpayers do not have bank accounts or computers or easy access to the internet to respond to IRS demands within the tight deadlines imposed. Meanwhile, when the IRS audits a billionaire, if they audit them at all, they're looking at structures involving partnerships and corporations and real estate depreciation and carried interest and offshore accounts and family trusts and charitable foundations, all of which require specialized knowledge to evaluate, and all of which involve legal questions where reasonable people can disagree about what the law requires. The billionaire has teams of lawyers and accountants whose full-time job is to create these structures and defend them if challenged, and they can drag out an audit for years, filing extensions and submitting thousands of pages of documents and negotiating settlements where they pay a fraction of what they actually owe. And the IRS agent assigned to the case is overworked and underpaid and knows that if they push too hard, they will face political pressure from members of Congress who receive campaign contributions from wealthy donors who do not appreciate being audited. This is not a functional tax enforcement system. This is a system designed to fail at the top while succeeding at the bottom. And the result is that billions in taxes go uncollected from those most able to pay, while working families are harassed over amounts that would not cover a single vacation for the people who should be under scrutiny. If you are starting to feel anger rising, if you are beginning to understand that the system is not just unfair, but deliberately designed to protect the wealthy while squeezing everyone else, then you are exactly where you need to be. And if you want to see how deep this corruption goes, if you want to understand the full extent of what the IRS refuses to do, even though they know exactly where the money is hidden, then subscribe now, because what comes next will show you that this is not incompetence. This is policy, and the people who benefit from it have made sure that fixing it is almost impossible. The EITC audits are particularly cruel because the earned income tax credit was designed by Republicans and Democrats together as a way to encourage work and reduce poverty without creating welfare dependency. The idea being that if you work and earn low wages, the government will supplement your income through a tax credit rather than through traditional welfare programs that create disincentives to work. It is actually one of the most successful anti-poverty programs ever created, lifting millions of families above the poverty line each year and providing an incentive for single parents to stay in the workforce rather than relying solely on public assistance, but by targeting EITC recipients for aggressive audits. The IRS has turned this program into a trap where the very people that was designed to help face intrusive questioning about the most intimate details of their lives, where they must prove that their children actually exist and live with them and that they are not committing fraud. Even though the vast majority of EITC recipients are perfectly honest and the error rate in the program, while higher than some other programs, is largely due to complexity and confusion rather than intentional cheating. And the complexity is deliberate because Congress has added layer after layer of requirements and phase-ins and phase-outs that make it almost impossible for a low-income person without professional help to correctly calculate their eligibility. And then when they make a mistake, the IRS treats it as potential fraud and initiates an audit that can take months or years to resolve. Compare this to how the tax code treats capital gains, which flow almost entirely to wealthy individuals. Capital gains are taxed at lower rates than wages. They can be deferred indefinitely through like-kind exchanges and opportunity zones. They can be eliminated entirely through the step-up in basis, a death loophole that allows heirs to inherit appreciated assets without ever paying tax on the gains. And when wealthy people do make mistakes on their returns involving capital gains or partnership allocations or foreign accounts, the IRS rarely has the resources or expertise to catch them because those audits require specialists who have been laid off or reassigned to simpler cases that generate better statistics. The Government Accountability Office has repeatedly documented this pattern, issuing reports that showed declining audit rates for high individuals and corporations, even as those groups have become wealthier and their returns more complex. And the GAO has specifically warned that this creates a perception of unfairness that undermines voluntary compliance. Because when middle-class taxpayers see news reports about billionaires paying zero in federal income tax or using legal loopholes to avoid taxes on billions in income, they start to question why they should be honest on their own returns when the system so obviously favors those at the top. This is how tax systems collapse, not through revolution or reform, but through slow erosion of public faith until enough people start cheating that the system cannot function. And we may be approaching that point now as respect for the IRS and belief in the fairness of taxation reaches historic lows. The most damning evidence comes from analysis of confidential IRS data showing that many of America's wealthiest individuals, people like Jeff Bezos and Elon Musk and Michael Bloomberg, paid $0 in federal income tax in certain years despite their wealth increasing by billions. And they did this legally by taking advantage of provisions that allow them to live off loans secured by their stock holdings rather than selling stock and realizing capital gains, and by claiming business losses and depreciation that offset any income they do report, and by using charitable foundations that give them control over billions while avoiding estate taxes and providing tax deductions for contributions that they ultimately control. The IRS knows all of this. They see the returns. They understand the techniques, but they do not have the resources or the political backing to challenge arrangements that would require years of litigation and hundreds of hours from elite agents who no longer exist in sufficient numbers because Congress cut their funding. And this is not an accident. This is the result of a deliberate strategy by wealthy individuals and corporations to defund the very agency that could hold them accountable. And they have done this by making campaign contributions to members of Congress who then vote to cut IRS budgets and impose restrictions on enforcement, and by funding think tanks and advocacy groups that put out reports arguing that IRS enforcement is wasteful and that the agency should focus on customer service rather than audits. As if the IRS were a retail business rather than a law enforcement agency. The strategy has worked brilliantly. Every dollar cut from the IRS budget saves wealthy taxpayers far more than $1 in avoided taxes. Studies estimate that every dollar invested in IRS enforcement generates $4 to $6 in additional revenue, which means that cutting enforcement is actually increasing the deficit. But deficit reduction is not the real goal. The goal is to starve the agency that could expose and punish tax avoidance by the wealthy. Consider what happened in 2010 when the IRS began requiring foreign financial institutions to report accounts held by U.S. taxpayers under the Foreign Account Tax Compliance Act. This was a major victory for enforcement because it closed off one of the primary ways that wealthy Americans had been hiding money offshore, and the IRS began collecting billions in additional revenue from people who had previously thought their Swiss bank accounts and Caribbean trusts were safe from scrutiny. But rather than celebrate this success and provide the IRS with more resources to pursue other forms of tax avoidance, Congress did the opposite, cutting enforcement budgets and imposing new restrictions on the agency's ability to collect information. And wealthy taxpayers simply adapted by moving money to jurisdictions that are not covered by FATCA or by using domestic trusts and partnerships that are even harder to audit than offshore accounts because they involve questions of U.S. law, where expensive lawyers can create ambiguity and delay. Do you see the pattern here? Do you understand that every time the IRS closes one loophole or develops one new enforcement technique, Congress steps in to protect the wealthy by cutting budgets or changing rules or creating new exemptions that allow the same behavior to continue under a different name? This is not a democracy. This is an oligarchy. And the tax system is one of the most important mechanisms through which that oligarchy maintains itself by ensuring that wealth flows upward and stays there, and that any attempt to reclaim even a fraction of what is owed faces overwhelming resistance from people who have the resources to make that resistance effective. The human cost of this system is measured not just in the billions of dollars that go uncollected, but in the stress and fear experienced by low-income families who receive audit letters and do not know what to do, who cannot afford to hire professionals and are intimidated by the bureaucratic process and often just give up and lose refunds they desperately needed for rent or car repairs or medical bills. Studies have documented that EITC audits cause significant psychological distress, that families experienced anxiety and depression and a sense of being persecuted by their own government, and that the experience makes them less likely to claim benefits in future years even when they are eligible, which means the audits succeed in reducing program costs not by catching fraud but by discouraging legitimate claims. This is governance by harassment, using bureaucratic complexity and aggressive enforcement against those who cannot fight, back to reduce spending on programs that help the poor while ignoring vastly larger amounts of tax avoidance by those who can afford teams of lawyers to protect them. and the system perpetuates itself because the people who could change it, wealthy, donors and powerful interests, benefit from keeping it exactly as it is. And they have every incentive to maintain the fiction that the real problem is welfare, fraud, and EITC abuse rather than the trillions of dollars hidden in complex structures that the IRS lacks resources to examine. Politicians can score points with certain voters by being tough on fraud even when the fraud they are targeting is trivial compared to the sophisticated tax avoidance practiced by their donors, and the media often plays along by running stories about individuals who cheated the EITC without providing context about how much more money is lost to legal tax avoidance by the wealthy, creating a public perception that the problem is people at the bottom rather than people at the top. What would it take to fix this? To create a tax system that actually enforces the law equally regardless of wealth? The answer is straightforward. Congress would need to dramatically increase IRS funding specifically for enforcement against high-income individuals and corporations. Hire thousands of specialized agents with expertise in complex financial structures. Invest in technology that can track offshore flows and identify abusive tax shelters, and provide political protection for agents who audit powerful people by making it clear that doing your job will not result in retaliation or congressional investigations. The cost would be maybe $15 to $20 billion per year, and the return would be hundreds of billions in additional revenue from taxes that are already owed but not collected, meaning this would be one of the most profitable investments the government could make. But it will not happen because the people who would pay those additional taxes have the power to prevent it from happening. So we are left with a system that audits the poor because they are easy targets and ignores billionaires because they are hard targets. And everyone knows this is wrong, but nobody with power does anything about it because the incentives are all backwards and the corruption is so deep that reform seems impossible without a complete restructuring of how political campaigns are funded and how lobbying works and how the revolving door between government and industry operates. The IRS audit gap, the difference between what is owed and what is collected, is estimated at over $600 billion per year. And most of that gap comes from the top 1% who underreport income and overclaim deductions and use aggressive tax planning that pushes or exceeds the boundaries of legality. But instead of focusing enforcement there, we audit families earning $20,000 because they claimed a tax credit they were entitled to but could not document to the agency's satisfaction. If this has changed how you see the system, if you understand now that the IRS is not an independent agency enforcing the law fairly, but a political tool that has been deliberately weakened to protect the wealthy while maintaining the appearance of enforcement by going after those who cannot fight back, then you need to see what we are revealing next, because the corruption does not stop at the tax system. It extends into every corner of government where concentrated wealth has the power to rewrite rules and purchase favorable treatment. Subscribe now, turn on notifications, and prepare yourself, because once you start seeing how thoroughly the system has been rigged, once you understand that what you were told about fairness and equal treatment under law is mostly fiction, you can never go back to believing the comfortable myths that keep most people compliant and accepting of their powerlessness. And that knowledge is both liberating and terrifying because it means you have to decide whether to accept the rigging or fight to change it, knowing that the fight will be long and difficult and that those who benefit from the current system will resist with everything. They have